August of 2021 to August of 2022, average rents increased from $1,700 a month to $1,900 a month. In August of 2021, attached housing in Wake County, the average was $1,700, and this August, $1,900. That represents a 12% increase in rents, which is pretty staggering by historical measures to see rents go up 12%. But during that same period of time for attached housing, the median, not average, but the median sales price in August of 2021 was $295,000, and by August of 22, it was $375,000. That's a 27% increase. So we saw a 27% increase in the median sales price of attached housing. At the same time, there was only 12% increase in rent. So that's sort of headwind number one that our investors are facing. The double whammy is that during that same period of time, mortgage rates have increased so much. If you look at what the principal interest payment would be on a home in 2021 at that median price, and apply the same percentage loan amount in 2022, but with that increased median price and the increase in interest rate, that resulted in a 71% increase in principal interest payments. So that's the second big headwind that our investors are facing. And we've got this, what we should feel like magnificent increase in rental rates, but it's outpaced by the prices. You add that coupled with the increase in interest rates, and our investors are looking at payments that are 71% higher for the same property than they were a year ago. And then sort of the triple whammy or the third whammy is because of that increase in average price, we've seen the average down payment requirement go up as well, by about $20,000 a property. So if you have investor clients like I do, you know, it's a strange time because there are more and more people that want to own property. They've seen their neighbors and friends and fellow investors make a fortune in the last few years from appreciation and value. But how do you acquire something? How do you get in the game when you're facing those three big headwinds? And so when Joe and Jerry met with me and started talking about the all-in-one loan, I became real excited. The design of it, you're going to get into and hear about. It's not really designed to be an interest-only loan. It's designed truly to help people pay their loans off faster. I'll speak about that in a second. But in today's market, there are tons of people that still want to get in the game. And the reason they do is, you know, we look at each other here in Raleigh and say, man, housing's expensive. Prices have just gone crazy. Real estate's so super expensive. But that's not what people are saying about us nationally. If you look at our market from the outside looking in, people from New England, people from California, people from the Midwest, this is still an attractive market to them. In fact, that's part of what's driving our prices is people are coming in from California and the Northeast and saying, I can buy a ton of house for the same dollars here. So nationally, we're still seen as an affordable market. If you think about the top 4 tech markets, and boy, that's been in the news lately, it would be outside of Boston, Silicon Valley, Austin, Texas, and us. And of all those 4, including even Austin, Texas, our housing's still more affordable than it is in any of those other places. So outsiders still see us as a value market. What that says to me is there's still room for significant appreciation in our market because nationally we're not at all, you know, an expensive market. So how do you get in the game with those 3 headwinds facing you? When I heard about the all-in-one loan, I was excited about it because while it will allow you and encourage you to pay the loan down faster, and I know Dave's going to talk about that, that's probably been the historical benefit of the program. In the short term, if you're trying to get into the game, or if you're someone that has an opportunity to buy a property, fix it up and flip it, that's harder and harder to find those, but there's still a lot of people, some of you may be with TRIA, now they have a new name there are a lot of folks that are doing that in our market, you know, where they're not gonna hold it more than 5 years. You can actually fix the rate on this program for 5 years and get away with paying interest only. So that's gonna lower the monthly payment and make some numbers for properties work where the cash flow just wouldn't work before. So I'm excited about the all-in-one loan for that. The other reason I'm excited about it, take out of context our sort of craziness for right now, is what I'm sure you'll hear about, that it's such a powerful program to allow people to pay their debts off faster. If you've been in seminar with me, and I see a lot of you that have, we talked about there being 3 phases to the ownership and development of a program of rental properties. The first is the acquisition period. We just spoke to that. This all-in-one loan can help some people acquire, make the numbers work where they wouldn't work before. The second phase that we talk about after you've acquired what you want or need in your portfolio is you enter into a time of debt reduction, because you want to end up in the third phase, which is cash flow. We talk a lot about Dave Ramsey saying you want all your rental property paid for, and yes, eventually you do. So it can subsidize your lifestyle in that cash flow position. Well, this loan, this all-in-one loan, is so unique and powerful when it comes to debt reduction. I know from my own personal experience, there have been times when I could have afforded to pay my mortgage down, but I was reluctant to apply that extra principal because I might need that money and I couldn't draw it back. With the traditional loan, if you pay down additional principal, you can never draw it back. Well, you're gonna be, I think, excited and find out that with this loan program, you can. You can pay that loan down and save a bunch of interest, but if something comes up that I need a new air conditioner, I need, you know, a new roof, or I have an opportunity to acquire another property, I can pull that back. And I don't know of any loan device or combination of devices that allows the flexibility this does. So I'm excited because it can help us maybe acquire some things in this challenging time where we're facing these 3 headwinds. But overall, for all of us, it can be a really powerful device that will incentivize us to pay our loans off quicker and get to that phase of cash flow, which is what we want, where our rental property portfolio is subsidizing our lifestyle with that cash flow. So that's why I'm excited about it. Look forward to working with you. Thanks for being here.
Thank you, Norman. I've known Norman for about 15 years now, and he's our longer, and he is probably one of the best and understands this market better than anyone. I'd like to just kind of segue now to a personal testimonial. This all-in-one product is awesome. I can give you my testimony, but it wouldn't be the same coming from the person that originates it, but I have it on my home and I love it. But I brought a young financial planner here today, Zach Womble, who's going to tell you his story. But Zach came up to North Carolina a few years ago from Florida, where he was with Smith & Nephew, and he used to sell surgical products and joint transplants and things like that. But got into financial planning and investment advising and became a customer of ours with the all-in-one loan. He is married to his beautiful wife, Ann. He has 2 little babies, like 3 and 1 now. So he's right there in the middle of life, and he really helps us with this product. He recommends it to his clients. We even got his brother in it not long ago. He bought a home here in Apex and bought it with the all-in-one loan. So Zach Womble, why don't you come up and join us, and we really appreciate you being here.
Thank you.
Thank you.
Good morning, everyone. I want to take you on a journey real quick of my process of the last 2 to 3 years within the all-in-one loan. And so first, just a show of hands, how familiar is everybody with the loan?
2.
Okay, so okay. All right, new. For me, I heard about it, I had the pleasure of meeting Dave February 2020. So rewind, this is before COVID, right? Before everything goes crazy.
Let's hope something crazy didn't happen after I leave here today.
Yes, that's correct, because we haven't seen each other since then. But I learned about the loan and my gears started spinning. And then for the next roughly 9 months, I tried to dispel it and convince myself this is not going to work. And played that mental gymnastics game for about a year. Until all of a sudden the light bulb went off. And I said, this is a financial tool that I can leverage and piece it in with everything else I am doing, and I'd be crazy not to do it. And I finally got the numbers to work in my favor. What I was hung up on was the variable rate. Okay, and that's personally what I was hung up on. I said, why would I not do a 2.8% 30-year fix? It'd be crazy not to do that. But again, the mathematics, and that's really what this is. It's a math product, and it's not magical. Anyway, with that being said, I wrote down some numbers here because I wanted to get in the nitty-gritty and share with you in good and what people might say bad times, because clearly the rates have gone up. It's still working in my favor, and I think it would yourself. So with that being said, I was in a 30-year fixed loan originally at 3.75%, and my interest cost was $866 on average per month. And so I knew that was the number I needed to see it beat. I wanted to see that I was going to save interest. And really that light bulb moment was when COVID hit, because I went from positioning my emergency cash within money market funds earning about 2%. And then all of a sudden I was earning a big fat goose egg just like everybody else. That money was sleeping, doing nothing. That's when that light bulb, I said, I can take this money from my emergency cash and I can position it within the all-in-one, still maintain all my liquidity of it. And now it's a tool. So I go from earning 2% to earning nothing, and now I'm saving, let's say 4% on average, by just positioning and moving that cash within the loan. From there, I then started the loan, let's just say fresh January 2021. So I've had it for roughly the last 20 months or so. Throughout that time frame, and again, let me step back to the mathematics. I also wanted to see if I did everything the same from a lifestyle standpoint that I was doing with the 30-year fixed, would I still come out ahead with the all-in-one? So I was originally making a $2,000 a month payment, and I was doing it bi-monthly, just how we all know you can get that extra month payment within. And I said to Chet, I think I'm gonna do a $500 a month every Friday. And so I get 52 payments within that loan, and again, it gets that extra month. But from a math standpoint, Dave's gonna dive into it. The first month, I've got my debt balance. Go 1 week in, I'm now calculating interest off of less debt. Go 1 more week, I'm calculating again off of less debt, and I'm sure Dave will dive into how that works. So I have it set on an auto switch, 500 every Friday goes over, and I'm still, from a lifestyle standpoint, nothing has changed. Like, I am not trying to pay down my house, but it's doing it on its own due to mathematics. And so from there, my variable rate was at the lowest 3.83%, and now at the highest today, it's at 6.3%. And instinctually you go, holy smokes, that's not good. But again, what is the effective all-in cost that I am paying on my interest? So in the first year, which you could say was the more favorable year with the lower rates, I paid a total of $8,870 in interest. That was a 15% decrease from my 30-year fixed loan. So right off the bat, I was like, Chet, this is awesome. It's like I saved 15% on interest. That's huge. And again, I still have the liquidity. Second year, rates have obviously gone up. Through what I've paid so far to September, plus let's say the next 3 months, I'm projected to pay about $9,685 in interest costs, which again is still a 7% interest cost savings from the classic 30-year fixed. But this is what excites me the most. And again, let me preface that I'm looking at this from an investment standpoint, financial planning, just looking at all these different tools where I can position the cash. That if I was to, so I get bonuses 3 times a year roughly, and I do take those lump sum bonuses and I position them temporarily in the loan, again, because I still have the liquidity. Let's say for a second I just don't do that moving forward, and I only make that $2,000 a month payment for the duration of this loan. I'm projected to have it paid off in 17 years instead of 30, a 43% decrease in my loan time frame. I haven't done anything different. All I've done is just used it as a tool, and I've moved the money into it. And again, I'm beyond sold with it. And then for the right people, most importantly, it's not for everybody, but for the right people, they gotta know about it. So that's my all-in-one journey.
Thank you, Matt.
All right. Thank you so much. The main event, we all set?
I think so. Yeah, I think so.
We've got, I'd like to introduce Dave Herbst. He's the Vice President of the All-in-One product. Everything all-in-one, so basically this is his baby. He came to see us from San Diego. He's a former Marine. And the one thing I love about Dave is you can feel the passion when he tells you about this. And he has this big quote that we always use and have written everywhere, and I don't want to screw it up, so I'm going to read it, but he loves to say, the all-in-one is much more than a mortgage. It's a solution to the mortgage itself and has the power to improve the financial health of an entire nation. And he truly believes that, and as we started learning it and bringing it to the masses, we felt it as well, personally, professionally, and I think you guys are really going to love what you hear. So, without further ado,
Thank you.
Dave Herbst.
Thank you, guys. I appreciate it. Thanks for your patience. I really am thankful to be here and to participate with you guys today. I know we had some technical difficulties. I use this computer all the time. It's probably the first out of 1,000 presentations that didn't go well. So I apologize for the delay, and thank you for your patience. So let me give you a little context to the information I'm going to provide, and I only have about 180 slides, so I'm going to try to hurry it along for you. Okay, get you back in your day. I always like to start at the start, and for me, the start is just some context in terms of who we are, so that it helps everybody digest why. I think why is often overlooked or not spoken about frequently. Why reimagine a mortgage? Why try to do things differently than everybody else does it? So briefly about us. You may know who we are, but let me just kind of go back in history just a little bit. So we're about a 29-year-old company. We just passed our, I think, 29th year anniversary here a couple months ago. Like most entrepreneurs who are living in the Bay Area of California, our founder and president, Christopher Matthew George, which is what CMG stands for, in CMG Financial and CMG Home Loans, he also started this organization out of his garage, like a lot of entrepreneurs out there. And we are family owned and operated, privately held, and that gives us a lot of agility, a lot of ability to rethink things and be progressive and kind of advance the cause of our customers and our business partners. It's really what's on our mind daily. While the rest of the industry just seems to be delivering the status quo and is really kind of beholden to interest rate, economic cycles, we think there could always be a better way to do things, and that's where our mindset is. This product and other products we've developed are a reflection of that. Fast forward to today, where I think our original Christmas party back in 1993 had maybe 7 employees. We employ today close to 2,000, have over 200 branch offices, licensed offices across the United States, national lender, well established, and I think actually today we are, I believe, the largest owner-operated lender on the planet today. So it's kind of significant. We probably hover around 30 billion plus annually. Maybe this year will be a little bit down as the entire industry is down, but we tend to grow production even in markets like now due to this product right here, because it answers a call. It truly does, and that's where I'll begin. Why reinvent or reimagine the mortgage? So I'm just going to start with some basic facts, just so that you have an easier time absorbing the information. I could quickly get into what the loan is and how it's structured, how it works. But I've learned over my 17 years of talking about this product that people need some context to that. Like why? Why would somebody go do this? And what matters, right? Why does it matter? So just some basic things, right? Some kind of facts or truisms, if you will. We know that most people, in order to own or buy real estate, have to rely on a mortgage, right? We need a mortgage in order to make, most people do, in order to make buying possible, without question. We know that interest rates tend to be the primary influencer of decision making, right? And I don't know that that's altogether healthy. I think you guys can agree. I think a large part of the market tends to make bad decisions based on interest rate movement. Rates go down, people refinance pretty quickly, right, to save a few bucks each month. And we know that just kind of kicks the debt can down the street, right, prolonging our debt pay down, which adds excessive cost to our life at the end of the day. We also know that when rates go up, people become paralyzed in a way, right? Stop making big financial decisions for themselves. Home buying is one of those that we know is very good during the right stages of life because it not only provides us shelter, but also creates generational wealth, building opportunities, and a variety of other things. It also stabilizes local economies and helps build commerce. There's a variety of things that spin off of home ownership. It's the backbone of our nation, essentially. It is still the American dream. But people tend to make these extreme choices based on the rate climate, right? When we think that's not necessarily the best way to do things. And we ask ourselves, why does that happen? Generally, people behave based on the products and services they have access to, right? So if we just try to reimagine those products and services to help people make choices more flexibly, timely, without being really kind of beholden to these economic cycles and variables that none of us, influence or control, then it might be good for people, right? That's really kind of the start of the idea behind the all-in-one, as well as other products that we have already engineered that are wildly different and are in the process of engineering today. So what do people do? Rates are up, we know that today. Not just mortgage rates, but the cost of living is up. Cost of living, when we talk about inflation, it's sort of a constant pressure that's always there, right? We know that. The cost of a pound of coffee went up nearly 70% between the year 2000 and 2020, prior to COVID. The cost of a four-door sedan went up about 78% during that same time period, prior to COVID and supply chain disruption, right? We kind of look at supply chain disruption as being the catalyst to lower interest rates and inflationary spikes, but the cost of living has been increasing pretty steadily. Real inflation. The price per square foot of real estate in the United States has gone up about the same amount, over 70% in that same time period. So again, as things get more expensive, people look to better manage or reduce their overhead every month, right? Their payment obligations. So obviously that's where our mindset goes. What do? We take out longer term loans. Anybody remember like a 2-year auto loan back in the day? Or a 3-year auto loan? I mean, can you still get one? Right? Now you're getting 7 and even 10-year. We're gonna be able to call our home a vacation home, a second home, and write off interest on that thing here pretty soon. We continue to build or extend the amount of time we're in debt in order to reduce payment obligation as pricing goes up, right? That's kind of the only lever we can pull. And again, that's not altogether healthy financially speaking. Today, this is fascinating, 9 out of 10, it's actually a little bit more than that, 9 out of 10 mortgage borrowers use a 30-year fixed mortgage on their home. It's interesting, think about, I know we're kind of a small, room here, but I guarantee we have some similarities, but we're all very different as well. We have a lot of differences. We make different levels of income, we have different obligations or challenges, financially speaking, but the mortgage industry tends to deliver really 9 out of 10 times at least the exact same financial product to homeowners, right, or home buyers. It's an oddity to me. It's sort of a telltale, if you will, that something's not altogether right. You're gonna end up with a result that is not necessarily that favorable if we continue to deliver the same thing to different people over and over and over again. So what does this lead to? To give you some contrast in terms of the difference between pricing pressure and our ability to afford the cost of living and homes, home ownership. The prices of homes have increased 118% since 1965. Income has only increased by about 15% over that same time period. So it's a large gap, right? Big disparity between affordability and cost. Mortgage debt today now exceeds $12.5 trillion. It's actually closer to $13 trillion today. Anybody hear that number in the media at all? We never do. Media never covers this stuff. We never hear about mortgage debt. We hear about credit card debt, student loan debt, all these things that are concerning, but nobody's actually talking about the level of debt that homeowners have and face to pay down. That's just the principal outstanding, you guys. It's just the principal outstanding. Add the interest cost on top of that. It's a huge number, big number. What does this lead to? Well, one of the things that we can point to, and that is studied pretty routinely, is the deficit in retirement income security. Because that's where we're all headed prior to retiring, right? Or prior to death, I should say, is with this place called retirement. Not to sound morbid, but the reality is we'd all like to stop working one day, and we hope to have enough money to be able to, live out our years comfortably. And it's very hard to kind of cut back our standard of living. So this measure is the gap between the amount of money that pre-retirement households are on track to have saved for retirement versus what they have to have saved. It's about $3 to $4 trillion today. So it's a large deficit. Without question, the mortgage of all the money that's spent on debt obligations each month at the household level, the mortgage is the biggest, right? That's without question, it's no secret. Accounts for about 43% of all that money spent on one debt, payment obligation. And it's getting larger, right, with interest rates moving upward. Mortgages, traditional loans have their place, it's true. They're kind of a commodity item. I'm talking about a 30-year fixed, a 15-year fixed, just the standard stuff we're all very familiar with. They don't take a lot of explaining. In the mortgage industry, we don't spend a lot of time describing or explaining how an amortization schedule works, right? We don't have to do that. People kind of already know, I've got a monthly payment. As long as I make that payment, I think I'm good, as long as I can afford it. The problem though is that nobody can argue these things, that they're slow, they're inefficient financial tools, meaning that they don't use all your money towards principal, right? A lot of your money is used towards interest along the way. In fact, that's paid up front. They're rigid, they're one-way financial instruments. A mortgage, you can only put money towards it. You can't take money back out of it, can you? If your hot water heater breaks or the roof needs repairing, or you'd like to buy another income-producing property, you can't just tap into all the payments you made over the last year and write a check. You have to go do something with that loan. Go get another one or go get a second lien on your house. So they're rigid, they're just very rigid. Again, our behavior is sort of shaped by the products and services we have access to. Products that have been in circulation and available since the 1930s. Everything around us is innovated since the 1930s, except the mortgage, if you think about it. These are also very expensive. I know we just came out of a low rate environment, and a lot of people, probably a lot of you, have low interest rate loans. You heard Zach's story of a very low rate on a standard mortgage. Most of the market out there has low rates on their homes, right? I would still argue today's rates are still low historically. They're still very low. It's still a very good time to be a borrower because it's still affordable. There's pressures, variables that are going on that are eroding that affordability away pretty rapidly. But rates, historically speaking, are still pretty low. But mortgages are expensive, even with low rates. Here's a quick example, okay? And I think we can all relate to some of this math. I'm using a $375,000 purchase price. I'm assuming 20% down. That's a $300,000 loan using the standard 30-year fixed. And I'm using a 5% interest rate on this mortgage. Great mortgage. Now I travel the country promoting this product and coaching on this product. So I don't keep up with standard or 30-year fixed mortgage rates routinely. But I hear that 5% is like so last month. Is that right, Chet? I mean, can you get a 5% 30-year fixed today, or is it closer to 6?
Yeah, pay a few points.
All right, so let's just use this though, 5%. What I want to draw your attention to is the cost of interest, right? The total cost of interest in this obligation here. It would equal $93,000 in interest for every $100,000 being borrowed at 5%. Great rate still, right? Better than we can get today. Even worse, when you kind of think about the concept of financing real estate, we're committing to pay a larger sum than our home's value or home's purchase price initially, right? Day one. In this example, it's 55% increase, right? So it's increasing the total cost of that home by 55% over its purchase price, over its value. Day one, you're committing to that, right, as a homeowner. We don't question it. We kind of look at it and go, it's the only thing we can do. It's the best thing we have, right? It's the way it is. One of the things that I kind of draw attention to is like, telecommunications. Anybody have one of these in the room? You all have one of these in the room, right? It's probably no more than about 8 inches from your hands right now. And if it's in your hands, please put it down. What do we have before this? What do we use to telecommunicate before this?
Pagers.
Pagers. Thank you. You still have a pager?
No.
I think we should bring it back.
They're a little before my time.
I think, yeah, that's true, right? To make a guy feel good. My first sales job, I was ecstatic to get my first pager. It was like, just what is this? This is awesome. You mean you could buzz this, and I know you're trying to get a hold of me, and all I have to do is find a payphone, right? Are there any payphones left? Do you guys have any payphones out here? There's none in California. I think they're all in a graveyard somewhere out in the desert in Arizona, probably. But the reality is that paradigm felt good, felt efficient. You didn't have to go back to the office, didn't have to go back home and hit the Casio recorder to listen. It was pretty efficient. Fast forward to today, when we can, send a text instantly to the other side of the world and get a response in a few seconds, or pay a bill, or Venmo your hairdresser, or whoever, in a matter of seconds. It makes the pager and that way of communicating seem pretty archaic, right? I think innovation is that way. You sort of stumble into, or somebody offers up, or kind of illuminates an example of a better way to do things. And then you start scratching your head going, ouch, man, we've been doing it wrong the entire time. Like, why didn't I hear about this earlier? We get that a lot on this product, right? We do. We set forth to innovate the mortgage, and that's what this really represents, because this sets people back. Regardless of interest rates, mortgages are expensive, they're rigid, they're slow, they're inefficient financial tools, period. What if we reduced our rate? It's still expensive. It's 52% interest relative to the principal we're borrowing, right? At 3%. It's a very high cost mortgage. And what if we were like everybody else? Now the formatting on this might be a little bit jumbled up because the presentation was built on a Mac, so I'm using a PC, so forgive some of this. What if we're like everybody else out there who tends to recycle debt, either mortgage debt, about every 7 years? That's historically true, about every 5 to 7 years. It's even worse, right? In this example, even at 3%, for every $12,100 paid in principal, $10,000 paid in principal, we are charged $12,100 in interest costs. It's 121% relative interest. It's not that great of a deal. 3% makes you feel good. You'll brag about it at the barbecue. Am I saying that right, barbecue? Because when I'm in Texas and I say barbecue, people get mad at me. It's barbecue. That's because mortgages are amortized. This is the crux of the issue, really. Mortgages are really nothing more than a payment plan. Most loans are. They're really structured all the same, where we bundle in the P and the I, the principal and the interest together. That's your payment. Make that each month, you should be all right? But what's sort of hidden is the amount of interest costs that you're being charged up front. This is where the inefficiency of the product really is sort of illuminated here. Interest paid up front. In fact, you'll pay 50% of the total interest due in the first 10 years alone, right? So it's just a massive consumption of personal resources that could be utilized for other things, or at least a big portion of those dollars could be used for bigger and better things than paying on mortgage interest. Great rate, standard loan, I understand it. Man, my money's not being utilized by me. The deck is stacked against us, right, in the lending industry. That's just the case. We make the argument that if people just simply had more flexibility, more control, more money in their wallet, they'd probably be more active in real estate, probably invest. We'd probably be able to start to close that gap, that retirement income deficit gap. We'd probably be a lot healthier as a nation, right, just financially speaking. So this is because traditional loans really ultimately are focused on interest rate. It's really also the only variable or the only lever we have in the industry to kind of pull, if you will. Interest rate, right? We borrow for as long as we can, and we try to qualify for as much as we possibly can. It's just our behavior, right? So we try to time our financing behavior based on rate cycles, or not, or we delay it, like a lot of people are today, right? Interest rate, that primary driver. We had Ben Stein actually at one point as our spokesperson. He's a great friend of our founder and president, Christopher George, and he actually is an all-in loan customer. He said one day, mortgages are just a mathematical equation. That's really all they are. These are the three variables at play. Interest rate, your balance, and the time or term, right? That's it. Much like investing money, same things. What good is it if you had an investment vehicle or investment fund that you could put money into and the rate of return was guaranteed, it was fixed, maybe at 10%? That would sound pretty good. What if the monthly obligation that you were required to put into it in order to participate was maybe $1,000? Okay, what if you could afford that? It all sounds good so far. But what if only $100 of your $1,000 each month for a while went towards building your principal? That 10% rate of return doesn't sound so good any longer. What if the other 900 went to fees? Not so good. Well, I just described essentially a mortgage. It's the way mortgages are created or structured. What we sought out to do is just redesign the variable, redesign the equation. And this is really kind of obviously a dumbed down way to think about it. If we can focus on reducing principal faster, as Zach eloquently, illustrated, then you reduce the amount of time you owe money. By reducing the balance and the amount of time you owe money, you reduce your cost. It's just a no-brainer. Problem is, mortgages, again, are rigid and they don't make this process easy. Could you prepay a traditional loan? Sure, absolutely. There's no secret here that would save time and money. Very few people do it consistently. It's somewhere around 4% of Americans prepay their mortgage down. And not with a consistent amount of money, and not really with any amount that's going to be transformative or life-changing. So the all-in-one loan is designed to not only provide the financing people need to buy and possess real estate. This is offered for owner-occupied properties, investment properties, and second homes, but it's also designed to lower the interest cost. That lowers the size and the cost of the mortgage faster. But the key is that it does this without requiring a change in budget, so no household change in your finances. Does it without increasing your monthly payment obligation, and it also does it without having to depend on interest rates. Rates could go high, you still have the ability to save. So this begins to build this kind of opportunity for home buyers, new home buyers, existing homeowners with a mortgage, who are looking to do other things, but they feel kind of trapped. Even with their low interest rate, that's the only value they have on their current mortgage today, potentially. But by changing the way their money is being applied to it, it opens up opportunities for them. I would argue that for new home buyers, especially the younger generations, Gen Xers and up-and-coming Gen Z, millennials and up-and-coming Gen Zs, I think that people want some sort of benefit or some sort of reward, not just the money. I'm a Gen Xer. Back in the day, I was astonished that somebody would give me a credit card. I mean, it was like, you're gonna give me a credit card? I'll take it. But I was taught to pay down debt. But generationally, it's a little bit different mindset than I think what up and coming home buyers and homeowners, how they think today. I think people today, as a result of having access to information and services and products and better ways to do things instantly, I think people expect better. I think they expect some reward for use of your tools or your services. It's not enough anymore just to finance your real estate. There's got to be something more that comes with that. And I would argue that a lot of younger people do not want to make the same mistakes as Gen Xers and even baby boomers. 60% of baby boomers in the nation still owe on their mortgage. This is part of the reason why there's a retirement security crisis that's mounting. It's estimated that by the year 2050, I know that seems far off, but it's really not, that about 25 million retirees will actually be living in poverty. People that had saved and done things well will be living at poverty or near poverty levels. This is where we're all kind of headed, where a lot of us are headed. And the mortgage is part of that path. It's part of the journey, part of the decisions that were made along the way. So here's how the loan is structured, getting into the meat and potatoes, if you will. It's a simple concept, so practical. That you're gonna ask, if this is the first time you've been exposed to it, you'll ask in your mind, why haven't I heard of this before? It is so simple, so practical. Why hasn't somebody else created this long ago or made a big splash on TV, promoting the product? I'll cover those questions here in a moment. But the concept essentially just marries together and merges together two everyday instruments, financial instruments, into one place, thus the brand name, the all-in-one. We used to name the brand or the product something different when we first launched it out in 2005. So this is a 17-year-old product. It's not new. This is something that we just designed in the last 24 months. It's been out since 2005. Same product, same structure, same everything. You're probably surprised, like, why haven't I heard about it? Partly because we as an organization number one, we don't advertise. Number two, we like to work with people. We think valuable products and services are provided through guidance. And we believe that's important, very valuable, right? People with people who stand for something and know what they're talking about. And this product takes a little education. That's why we're here today. It's hard to get this product concept in a 15-second ad spot and people to go, oh, that sounds good. But you'll understand that it's so simple, it would make sense to put it on TV and whatnot. But as a 17-year-old product, this is something that ultimately reflects the way lending is done in other countries. It's really the inception of the concept. These types of products that do this, that bundle two things together, were born out of Western Europe, Canada, New Zealand, Australia, India, several other countries use these types of products. Our first brand name for the product was the Home Ownership Accelerator. It just inferred that people want to pay off their home early, and that was most important. So think back in 2005. Everybody was leveraging debt, and we were out there promoting a product that said, deleverage your debt. Deleverage your housing debt, you'll be better off if you do it. To date, we still have no losses, no delinquencies, no defaults. Even through the financial crisis of 2008, even through COVID, it's performed exceptionally well for us. We changed the brand name somewhere in 2010-ish because our loan officers couldn't spell the word accelerator correctly, so we had to make it easier, all in one, much easier. So here we go. The two components of the product are, number one, of course, the mortgage, right? You need financing to buy and possess real estate, most people do. The second component is secured banking, personal banking. And when I say secure personal banking, I mean a full-fledged checking account. So let this sink in briefly. Mortgage financing or home financing combined with personal banking into one financial product, and why that makes a lot of sense. Here's where an easy to understand illustration of why the concept makes sense. Think first of your checking account. Anybody here have a checking account? Not a pile of money? Well, think about it. The reason why we illustrate as a pile of money is because very few people who can qualify for home ownership, have zero or a negative balance in their checking account. We all tend to have money floating in our checking accounts, right? Savings accounts. Maybe a little today, maybe a lot after you get paid. And I know that checking account ebbs and flows in size, but it's a positive number for the most part. I'm sure there was a stage in some of your lives, I know mine, where it was hard to keep a balance in that thing, right, early on. But then you kind of advance and establish yourself and gain better cash management skills. But here's a fact. Every single one of our homeowners today use a checking account to manage their income. Every single one of our future home buyers uses a checking account to manage their income, in which they're going to pay their mortgage from, right? But think of your mortgage debt in general as a whole. This makes sense, right? The contrast, because it's money you have and money you owe. And not just owe, it's money you're paying interest on, right? And we know that the interest that we pay on our debts is significantly higher than the money we earn on our piles, our money, right? What the national average is for interest yield on a checking account today in America? 0.03%. Yeah, so very, very low. I know there's some high yielding accounts out there, that's fine. But we still get paid less in our checking accounts and savings and cash accounts than we have to pay in interest. Not just an interest rate, but volume of interest that we have to pay out over time. The reality is, as I've already demonstrated, the longer you remain in debt on that hole, even with a low rate, it's still costing you an arm and a leg and setting you back, slowing your progress, ultimately, right? And we make our payment, and because it's amortized and our money's hitting interest first, the interest obligation first, we make very, very little progress towards principal reduction. That has an end at the end of it, I'm sure. The other thing is that this is kind of something that a lot of people really don't think about. There's a lot of money that passes through a checking account over time. True? Right? For a second, add up how much money is transferred or you've managed through your own checking account in just the last 5 years. For most Americans, it's more than they owe on their home. You pay off probably a couple homes. There's enough resources made and managed through this cash account to get rid of our debts. Why does it take us 30, 40, 50, 60, or never at all to get rid of our debts? People tend to remain in debt forever. This begins to build on the concept of combining these two accounts together, because something really special happens, and it's automatic. If the value of the checking account isn't the interest rate, but rather the access to our money, the secure access to our money, why can't we just simply build a mortgage product with the same access functionality? Same secured access features, a mortgage that also functions as your checking account. That's really all the all-in-one loan is, combined banking and borrowing into one single place. And I'm kind of moving down a little bit lower, street level here about how it works. When deposits are made into the checking account, the all-in-one loan checking account, you literally get a checking account when you take out this mortgage. Again, it can be used for refinance or purchase, for any occupancy, residential real estate, 1 to 4 unit. I'll go through some of the guidelines here in a moment. This account gets activated within about 30 days after we close the loan. The customer receives their banking features. Check writing, online banking, mobile banking. Anybody here own a rental property? You do? And what day of the month do you collect rents?
Would be the first 5.
The first 5. Very honest answer, sir. If you'd said just always the first, I would have probably called you out on that. And then what do you do with your money? Does it go to a checking account? And then you make a mortgage payment on that home probably. Imagine getting that check, that rental property check, and putting it on your countertop, taking out your all-in-one loan mobile app, imaging that securely. It hits the checking account that came with your mortgage on that home or on your rental property. But it doesn't sit there. The benefit of the all-in-one loan is not to allow your money to reside, your idle cash, even for a day, to sit there doing nothing for you, earning you nothing. Instead, it automatically applies it to the balance, to the principal balance, 100%. This makes it the only principal paid first mortgage in America. Only 100% principal paid first mortgage. Never is any of this money applied to interest cost. Always goes to principal to reduce what you owe. That makes a lot of sense to keep it, to allow the money to land in the mortgage, because this isn't just your regular closed-end mortgage. It's a first lien position, 30-year draw home equity line of credit. That's what the all-in-one loan is. Foundationally, 30-year draw, first lien position, home equity line of credit. It's what we use to buy or to refinance out of a current mortgage and pay down the mortgage balance on your home. It literally allows you to put money into it by any amount, on any day. This is how you pay down principal, just by making a deposit into the checking account. The longer you keep money in there, it's always applied to principal. And then you begin to save dramatically, faster. You take money out, your cash is kept liquid. Of course that makes sense, because it also serves as your checking account. You need to pay some bills. But gosh, you guys know how it works. We don't spend all of our money on one single day. I mean, some people do, but you get paid on Monday, and by Tuesday, your checking account's at 0. We spend periodically, right? There's weekly expenses, one time a month expenses, quarterly stuff, annual stuff. Christmas is a good example, one-time event, right? And so we kind of let our money loiter, the money we need to spend, right? If your cell phone bill isn't due until the 25th, but you get paid on the 1st, right? This loan allows that money to go to work prior to you needing to spend it on that cell phone bill, or your utility bill, or grocery shopping this coming weekend, or whatever it may be. It begins to build this incentive, this visibility to debt reduction, cost avoidance, just by using money you already have. It's so brilliant, so practical for people. It's exactly what people need today, debt management. The biggest benefit is how interest is computed on the loan and charged. So instead of the P and the I being wrapped up into one monthly payment obligation, where it's the interest is sort of invisible, right, in your monthly payment, what we've done is we've separated the two. P is paid by making deposits. It impacts your principal balance that day. Then it recomputes interest nightly. It doesn't charge nightly, it just recomputes interest nightly. Simple interest, there's no amortization schedule. None, we completely ripped it out. Nightly balance at midnight, so if you just got paid today, or took a picture of your rental property check, right? That hits the all-in-one loan balance, pays it down, assuming nothing is done that day, no money spent. It's gonna take that principal balance at midnight, times the rate, divided by 365 days. That equals what's called a periodical daily interest expense. And it does this every single day throughout the month. Right, so you now get to gain a lot greater control of what your costs are gonna be after the month is ended, because that equals, your interest payment equals each day's cumulative interest cost. Does that make sense? Interest computing nightly at midnight. On the 1st of every month, customer gets notified. Hey, your statement's ready for the month of August that ended just recently. If you want to see all your transactionals, it's completely consolidated statements and online portal, so you can see everything. But it also shows you that interest cost for the 31 days of interest from August. And that's your payment. That payment isn't due until the 21st of September, 21 days later, where it's swept out of the account automatically. You don't even lift a finger to pay interest cost on this mortgage. You're not sending away payment. It just takes it from the money you have available in the line of credit. So it's very automated. This just reoccurs every single month, right? When September ends, my September payment, which equals each day's cumulative interest cost, won't be due until October 21st. That's sort of, and I don't want this to kind of just go, over anybody's, heads. The brilliance of this is that it keeps the money you have to expense towards the mortgage, the interest expense, in the account for an additional 20 days, right, for you automatically, to help continue to compound your savings for that next new month before it has to be, you have to pay that bill. So the whole time your money's at work, that's what's great about this product. Just set it and forget it. You're functioning, as Zach said, like you normally do. It's hard to go late. This is why it's one of the reasons why we don't have any reported delinquencies on the loan at all. It's really hard to go late. Money's always available for expenses, right? Bill payment, supported by Visa, FDIC insured checking account, mobile banking. A little bit closer look. I'm going to run you through an example here. Same example I've been using. So $300,000 loan size. Unlike a traditional mortgage where somebody's income. Think about it real quick. I always kind of use this analogy. Can you pre-qualify for a mortgage without having a property picked out? You can. You can get a pre-qualification letter to start home shopping, right? But can you get pre-qualified for a mortgage without any income? Nope. Can't do that. Everything is centered on income and ability to repay, right? But in the traditional loan world, whether it's a car loan, motorhome loan, boat loan, or a mortgage, your income after you close doesn't matter. It's not being utilized. As long as you take just a small portion of that and make your payments, that's it. In our loan, all of the income matters. All of the receivables matter. Bonus income, tax refund if that ever happens anymore. Commission, right? Just regular wages, rental property income, dividends, passive income coming in. All of it gets utilized automatically. So I've got some income in here and some spending, and I'm comparing it to that 30-year fix. I'm gonna use a 3.75% rate, so really low, just to kind of test. And then the all-in-one loan. I'm using a rate environment assumption in this example that will send the interest rate on our loan up and keep it up indefinitely. From current levels up by 1% and keep it there forever. In this example, this is how powerful income can be. An interest rate that's significantly higher and will stay high compared to that traditional loan that's already in place. When the loan closes, each customer receives a congratulations and what to expect letter. Prior to closing, we also phone call. We actually make a physical phone call to every single customer that's about to close. Call it our QA process. And it's just an opportunity to answer any questions, go over the loan's terms again, and make sure that it's closing as expected. As a line of credit, you can just simply pay off a current mortgage. You can pay off a current mortgage and gain access to equity money, right, up to our limits. You can get cash dispersed at closing. We want to make sure we're not over dispersing cash. We ask that question. Are you sure you want $108,000 at closing? Because you're gonna have access to that after we close. Don't want you to overpay in interest if you don't need it. Things like that. It just enables us to make sure the customer feels empowered, and they're also engaged with the loan so they can start saving after they use it. It's kind of white glove treatment. Our two servicing partners that service the loan nationally are two banks that may not be household names out here, but those banks are North Point Bank, they're headquartered up in Grand Rapids, National Bank, and Merchants Bank of Indiana, out of Carmel, Indiana. Both of them are deep partners of CMG's and have been for a very long time, servicing this loan. They are the ones that service the account, issue all the banking features. As a mortgage banking firm, we aren't a deposit bank. We needed to make sure we partnered with deposit institutions in order for that secure banking access to occur merged with the line of credit. So they service the account. As an example, month one, it takes us, like I said, about 3 to 4 weeks for us to set up the account after closing. Sometimes it's a little faster, but that's about how long it takes to receive everything through the mail, right? All your account features. Feels a lot like you just open up a brand new checking account. That's what it feels like instead of a mortgage. And again, the engagement with the loan, the sooner people engage the loan, the faster they'll begin to save, right? It's gratifying for people. So just in this example, I'm anticipating the balance doesn't move for the first month. Then, as soon as you gain access, your first deposit pays down principal. It's a gratifying feeling for those of you that have the loan. Every time you get paid, it's cool. You literally wake up the next day, your balance is reduced by your paycheck. You're like, gosh, you start to become more conscious of your spending. You start to make better decisions. I think that's also what a lot of people need today. But it keeps you liquid. So there's some financial independence and security that comes out of it, naturally. Gives you opportunities. Assuming some expenses going out through the month. What I don't have on this slide is the interest payment. There is none on month one. The interest payment for month one will occur during month two, on the 21st of each new month. Money left in the account remains there as home equity. Now, a couple things to consider. Why would I end up with a lower balance than where I started if I'm spending my money out of it, right? Part of the reason why this pays down is because you're no longer having to make a mortgage payment, your traditional P&I payment. So if you have a payment right now, a P&I payment, add that payment up in your mind right now. And on a monthly basis, imagine not having to make that payment to your lender. Instead, what if it was just deposited into your all-in-one loan? It now, in effect, all of it goes towards principal that day. So we're converting people's P&I payments into 100% principal reduction of their home loan and keeping the money liquid for use if they need it. But if you don't need it because you're comfortable spending it, the assumption here is that it's helping you drive down your balance. You can turn around and write a check and go fund something that you need to go fund, a financial challenge or an opportunity. But the assumption is that if people can qualify for a standard mortgage, 30-year fixed, or even a 15-year fixed mortgage, and they're comfortable spending those dollars, they would be as comfortable keeping them in this account to help them drive down their balance faster. That's number one. Number two, there's always money that it tends to be floating in accounts, right? Just some residual cash left over. Maybe we build that up to a rainy day fund. Maybe we're gonna spend it in a couple months, but either way, that residual cash continues to help compound savings and drive down the balance faster. So this just accelerates equity growth in the property, paying down. Long-term results in this example, again, this is just a standard customer making income that would qualify for a regular 30-year fixed mortgage. Having them paid off at 8.8 years is pretty gratifying. Our average trajectory or payoff timing for an all-in-one loan customer is about 9 to 11 years on average. 9 to 11 years. That's how fast people pay down. In this example, because they're paying down so rapidly, even with a higher rate in this example, they're saving almost $70,000 in interest costs. So, time savings and interest savings because of rapid principal reduction. All the meanwhile, money is kept liquid. So we have an interactive simulator that I'm kind of showcasing some of the pages here, and I'll show you where to find that online. But it breaks down any scenario in a matter of a couple moments. Anybody can use it. It's publicly displayed with all of our interest rates and options on it. Anybody can use it. It's easy to use, and it breaks down all these things comprehensively. What's my average payment on it? That's interest, right? Again, remember, there is no fixed payment on it. Why would you want a fixed payment when we offer a payment that reduces automatically every month? It will fall to zero faster. That's what we want. Instead of being locked in for 30 years with a payment amount, how about you start here with a payment amount, and it's just interest only is the minimum, and that falls to zero more rapidly. So we want to reduce that. That's the goal of the loan. As Zach also, talked about his own personal circumstances. We map out like comparison loan APR. This is the same as getting a 30-year fixed at 2.3%. The rate on the all-in-one loan in this scenario would have to increase and stay at almost 10.2%, and stay there indefinitely in order to cost the same as that 30-year loan. So dramatic results. Would you like to be paid off in 106 months? In the comparison loan, this person would still owe almost $240,000 in principal. This is why Americans owe about $12.5 trillion, because the loans we have are just slow instruments, right? It's kind of impeding our progress. We also break down to the week exactly where, as a forecast, where your money is given what you input into the calculator. So dramatic results. The line of credit as a mortgage security instrument is structured this way, you guys. Again, it's the only 30-year draw line of credit in America, the only principal paid first mortgage in America, the only mortgage in America that actually recomputes interest nightly over the entire term. Very, very cool things. Companies try to seek out one only statement. We've got 3 or 4 on this product. It's some big benefits. What a customer qualifies for originally, whatever amount that is, the HELOC limit that we close at, that remains unchanged for the first 10 years. After the 10th year, we begin to reduce the credit availability. So this is a good reason. The reason we did this is so that we don't charge somebody a balloon payment. We don't want there to be a balloon payment. We don't want there to be a structured P&I payment. We want to keep people free to use it over 30 years, but also enforce a pay down and pay off. And this is how we do it. Just begin to limit what you can borrow from yourself slowly over the last 20-year period of time. Right. So if I got $300,000 approved, I would have that available to me for the first 10 years, and then it begins to reduce, evenly monthly by 1/240th until it hits 0 by month 360, the end of month 360. Right. So imagine all the ways you can use this flexibly over time. I have a friend who called me bragging that he had just paid off his all-in-one loan for the 6th time recently, right? And I'm like, it's awesome. He's utilized it to invest and pay down, invest and pay down, fund other things that he wanted to do, remodel, all with the same mortgage product. So if you're wondering what's in it for us, that's part of the reason. Reduced risk, and we create a stickier relationship, longer lasting, right? More flexible, more controlled relationship with customers. It's a good thing. Something really special happens when you actually create products that benefit consumers first. You tend to be loyal, right? Stick around longer. Credit allowances, in case you're wondering, some of these things, what we lend to. So primary residences, non-Texas homestead properties. We lend this product in Texas, just in case anybody owns a property down there. Texas was kind of the represented some challenges for their primary residence and laws that exist down there. That's why that says that. So every state across the nation, for primary residences, this is the matrix. We lend up to $3 million to 70%, $2 million to 80%, right? We'll actually go to 90% loan to value, so a 10% down payment purchase on a primary residence. Yeah. So, it's not just your $200,000 line of credit, right? It provides a lot of financing. Second homes, pretty much the same matrix, up to 70% to $3 million, 80% to $2 million. Investment properties, 75% loan to value for a purchase and rate and term, and 70% for a cash out. Now, cash out to us means that you owe $100,000, but your home is worth $500,000. You could get a line of credit to 70%, right? Just pay off the current balance and have access to that money. Good news is that we structure our pricing associated with the interest rate on this loan relative to the initial advance at closing, not the line amount. So it's a good way for people to get into having liquidity without costing more money up front, right? Some of the guideline allowances, just to highlight a few of these. So there's no impound account allowed on the product, just in case that was maybe funneling through your mind. We don't want you to pay us your tax and insurance premiums up front. Along the way, we want you to keep your money for as long as possible to benefit from it before you have to make those premiums. So there's no impound account. We have a very aggressive asset depletion feature on the product. Anybody know what that means, asset depletion? Without pledging any money, for people that have done a really good job saving, maybe retirement, things like that, but they show very little income, maybe on your tax returns. Self-employed, people obviously make this are a good example. We can use assets to help a customer qualify, and it's a very aggressive way to, Fannie Mae and Freddie Mac also have the same features, but we have a different formula that's actually much more favorable. We use few income, delayed financing. Anybody have cash? Anybody a real estate agent here? I would imagine. There's still cash buyers out there putting down cash. Okay. Here's a really cool way to win that deal, just in case they're shopping you and whatnot. But Oftentimes we find cash buyers want to retain their money back out of the property as soon as possible, right? Or at least a portion of that cash investment. Right after we close, we can take an application on this product and help that customer retain up to our maximum allowance in cash the day after. I mean, it'll take us 20, 30 days to close a loan, but the day after they close their cash purchase, they can do a cash out refinance with this, with no seasoning requirement. So it's a cool way to do it. Maybe customers or home buyers that have larger down payments than just the minimum is also a really cool opportunity, because sometimes, you know, people want to come in with, I've got 25% down, or, you know, whatever it may be, 15% down or 30% down. We could actually, if they qualify, provide them a line of credit higher, right, than their initial balance. In other words, if somebody has 30% down as an example, we could provide them an 80% line of credit, but their initial balance is only 70%. So their costs are lower, their interest payments are going to be lower right out of the gates, but they retain access to 10% of that down payment, right? Just as an example. So the idea here is to provide people liquidity. That liquidity creates, you know, flexibility, confidence, right? Control, and incentive. Let's see here. We can have a customer just in case you're wondering, how many of these can a customer have? Up to 3. 1 per occupancy. We will be releasing the ability to get additional investment property all-in-one loans here very soon. We get that a lot. We find that real estate investors have more than just one, right, property. So we want to be able to say yes to that and provide additional all-in-one loans when it makes sense. And if in case you're wondering this, yes, when you put this on different properties, it's one security instrument, meaning the HELOC, that comes with its own checking account. So we can't bundle them together. Not yet. This is something that we're definitely interested in doing or pursuing down the road. That's called cross-collateralization, right? Wrapping your homes up into one security. That's exactly the way it's gone in other countries. In Canada, when you buy real estate, you buy multiple properties using one loan. You just re-qualify for higher limits, and it serves as your bank accounts. So it helps you pay down the debt faster. It just makes sense.
Does the interest stay the same?
In Canada?
Yeah.
I don't know. It may not. I'm not intimately, you know, that familiar with how interest is calculated with some of their. Are you moving to Canada?
No.
No, okay.
I'm just curious, you know, if you bought first property 3 years ago with a 3% interest, and you
Yeah.
looking to buy a second property now.
Yep. And one of the reasons why these were born in other countries is primarily because their tax deductibility benefit had been eliminated along the way. And it's, you know, something to consider. We still have that benefit here, of course, but that was sort of the catalyst in other countries to create a more efficient way of using idle money, right, to avoid cost, interest. But I believe there are loans in Canada and other countries really that are similar to the way we used to lend money for real estate prior to the Great Depression era here in the US, which is to shorter term loans with compounding interest. So it sort of incentivizes you to pay down your balance faster, or you get, you know, a compounded interest charge annually. So the mindset's different. Here we're like, you're fine. You're 65, you're fine, we'll get you another 30-year loan. It just doesn't make sense, right? You sort of do that routinely, and it just doesn't make sense. This is probably the most efficient way you can manage debt and pay it down faster while interest is recomputing nightly on whatever balance you owe that you control, right? So it's probably the coolest benefit of it. Coming soon, and this is new to our CMG folks here, we are also chipping away at a one-time close construction to perm all-in-one loan, which will be really fascinating. Yeah, it's very cool. Imagine buying a chunk of land and qualifying for this loan, and it activates, you know, as it normally would. So 20, 30 days after we close the loan, the borrower receives their checking account banking features. They've been approved for a total line of credit at X. What we're going to do is, as we disperse draws to fund the construction, we'll increase their advance or access limits until it finally achieves completion of construction and they've got access to all this. But while that occurs, they are also using it as their primary checking account to pay down the balance. So imagine at the end of that, they now have this liquidity, a lower principal balance, and we're also considering making it where we can modify the credit limit based on home value after construction is completed for a higher limit without having to refinance. So really helping people pay less for their homes, but again, remain liquid. You got a question?
Is there a cost to the checking account?
So no cost for the checking account to come with it. A third-party vendor or like ATM machine surcharges, things like that, we reimburse monthly. So it's not intended to be a fee-rich checking account. There might be costs associated with wire transfers, right? Depending on the bank that
No service,
you wire.
no
Just
service
standard.
charge.
Yeah, it's all standard checking account stuff, but we reimburse surcharge fees for regular use of the account ongoingly.
Hey Dave, you might tell them too that you don't have to leave your bank to do
No.
this. You can transfer from the bank account you have now into this, so you
Totally.
don't have to like abandon your bank you've been with 30 years.
Yeah, for sure. We never advocate, departing current relationships and accounts, things like that. We really believe that it's just a better choice or a higher use of idle cash, right? Does it make sense for everybody to put all of their money in through this account? I wouldn't necessarily advocate that either. I do keep a Chase account. I keep a minimal amount there, very minimal, in case I ever needed to go get, cashier's check or something like that. I'm telling you that all my paychecks go directly through my all-in-one loan. My money is being used more efficiently that way. But again, everybody's different. I think having the choice to benefit this way from money people already have is key. And you can link any number of external accounts to it. So you can ACH money back and forth routinely, very fluidly, right? Without any problem at all.
Does money move same day?
What's that?
Does the money move same day or?
Depends on the bank. I mean, sometimes banks hold on to money. Right? It depends also how you transfer.
Yeah.
In most cases, when you transfer from the all-in-one loan and pull it in, a lot of times banks will delay letting go of that money, right? They may say it's processing for 48 hours. Yeah, and sometimes that's not the case, I find. With my Chase account, it's 24 hours.
Yeah, ACH is faster.
Yeah. Yep. Yes, sir.
What is the mortgage rate indexed off of?
Yep. The index is based on the 1-year CMT, 1-year constant maturity treasury, right? AKA the 1-year treasury rate. Obviously, we've seen an increase, right? It's lifetime average or 25-year average roughly is what we use with our forecasting tool. Is about 2%, 2.1%. Currently, it's at 3.48%, right? And then we have margin spreads as low as 2.5%. So mortgage rates on the loan today are very competitive with market rates on conventional loans. They begin in the high 5s, right? It's right around that range today. If you'd had this loan in the last, call it 15 years or so, your rate would have averaged probably around 4.5%, 4.5%, somewhere in that range. Yes, sir.
I know you have different formats of the loan. Sometimes it varies every month, sometimes it varies every year, but you can lock it in for a 5-year or 3-year fix. What
Can, yeah.
you talk about?
So it's
How long can
foundationally.
you fix it if you're hung up about a fixed rate?
Yeah, it's foundationally a monthly adjustable loan product. Again, interest rates aren't our friend. It's all about driving down principal balance. But you can, right, to hedge against interest rate risk and interest rate cost, especially during rising rate environments like we have been experiencing. You can lock in for 3 years or 5 years, and then it turns to a monthly. About 80%, maybe slightly lower than that, 78% of our business is monthly. People that get this loan, because they realize that my rate is not driving my cost exclusively. It's a smaller factor these days, right, in this loan, mathematically, much smaller. And you may not benefit when rates do tumble, right? So they're cyclical, of course. Rates go up, rates go down. It's no surprise. The index that we've chosen, we used to use LIBOR. We used to base it on LIBOR. Can no longer manufacture LIBOR-based securities in the U.S. So we transitioned over to the 1-year CMT. So it's an index that's widely used in the industry and has been for a long time, and a margin spread that gets locked in, but you can't fix it for a short period of time.
How long can you fix it if it's an investment property? 3 years?
3 years.
But if it's your own home, you can.
5 or 3.
So if I had my home paid for, I could come to you and borrow up to 80%, up to 70% of the value of my home, get a line of credit for that, don't have to draw anymore.
No.
And then I get a chance to buy an investment property, I can just draw against that line of credit and pay cash for the rental property.
That's right. That's right.
80% on your primary.
Yeah.
80% loan to value.
On a cash out.
On a cash out?
On cash out for a primary.
For primary, yes.
So I could borrow up to 80% of my home value, just have that line of credit sitting there to use whenever I want to.
Yep.
Make opportunistic purchases where I could go in and pay cash.
That's right.
For a rental property.
That's right. Yeah, and oftentimes we advocate against getting a second all-in-one loan unless it makes sense, but oftentimes people are able to, either they already have existing equity available or they build the equity needed through pay down to do that, just write a check out of it. Basically, you're consolidating that into one really powerful tool.
If I may, you leveraged it to capture the real estate surge in our market. When I got the all-in-one in 2019 at about $50,000 delta, and then I saw the surge, so I refinanced again and turned it into $250. So I don't touch the money, but the delta's there. It's my pillow.
It's just there in case you need it.
I have a very comfortable pillow. $250,000 sitting right there, not being touched. That's accelerated being paid.
Go ahead, Zach.
Once you pay off your loan, you don't have to close the
Right.
loan.
Right.
If it just sits there idle as that accessible cash, is there a fee or a cost to sit dormant?
Yeah, you're absolutely right. It doesn't close automatically. You can ask, call into the servicing department and have it closed, receive the deed on your property. You can even keep the checking account open. You can even refinance into a higher line of credit, right? With new value. We can detach the checking account, reattach it to the new loan, right? So that you don't have to change the routing number, checking account, bill pay, things like that. So, just keeps the thing intact. And get to use it however you want. There's an annual fee. There is, starting in the second year, $60. That comes straight to me. I'll make this worth it.
That's the fee for the loan run.
Yeah, most lines of credit have some sort of servicing or account access fee to it. This helps us get reimbursed a little bit for all the transactional costs associated with keeping it open. Yeah, good, sir.
Can you do this on free and clear?
You can do it on free and clear. We get that a lot. With the requirement that cash is needed at closing. So just to get and to keep, just to have liquidity, it's a primary mortgage product, so full title policy, full appraisal, all the things you'd expect with any standard mortgage. We try to identify when it makes best sense to just get a standard HELOC if you're just needing kind of some liquidity. Because standard HELOCs have a little bit less expense to them, right? So that'd be the question. If you're not needing cash at closing to fund a financial need, then we would want to either wait till you needed that, like you're within range of needing the money. If you're out home shopping for another investment property or something, call it 90 days out and you're starting to look, then I think we should get your loan in process. But if you're just like, hey, I don't know if I'm ever going to need the liquidity, I just like the sound of it, then I think in those cases, we just think a lower cost line of credit is probably more suitable. But yes, we do. Yeah, there's no restriction
I can
there.
get a HELOC on an investment property otherwise.
Right, it's very hard to achieve these days, yeah, HELOCs on investment properties. And if you do, they're very expensive. Yep.
Do you already, or is it in the pipeline to have all-in-ones for land?
For land, as land loans? Good question, Zach. Not yet. Not yet. We've kicked around ideas like making a student loan all-in-one loan, things like that really help people get rid of debt. But yeah, I mean, these are things, even a reverse mortgage option, right, where it actually gives somebody a limits on money they can take out, but is structured for people with just, passive income and fixed expenses, fixed income, who don't necessarily like the sound of kind of giving their home back, right, to the bank system, aggressively. So we're working on some things. That is one of them. Yes, ma'am.
Why does it take so long to get your checking account opened?
About 4 weeks?
Yeah.
Yeah, 3 to 4 weeks. It's actually, I buffer that. It's probably a little bit sooner than that, but yeah, because there's two things going on. It's a great question. There's the loan that's being set up in the servicing portal, a checking account that's being manufactured by the bank. They're merged together in our portal. A customer account is generated and made accessible through the app for the customer as well as online, and then mailed to the customer. So, in all, by the time it's received in the mail, I always just say about 4 weeks. Oftentimes it's faster. Yeah.
So what I might add to that, think about this, when you go on in banking, when you go to a bank to set up an account, right, your online banking is not established right away. You get a checking account, and you gotta go back to the bank, you gotta set your online profile, so there's some administrative things that happen after the fact. It doesn't take weeks, it can take days. You think about, you gotta order your debit cards, it takes a little while for the plastic to get manufactured and mailed.
So it's weird, like, honestly,
Yeah.
that doesn't happen anymore, like, when I went and opened up accounts for my kids, like, they
It-
gave that stuff to us
it-
at the bank.
It could be because you
Like,
had the process.
and I'm, you know, I'm fine with that,
Yeah.
I'm just saying that one of our clients, you know, was like, why does this take so long?
It sounds like to
So
me,
I would ask.
it sounds like to me what you're doing is you're doing all the administrative functions behind the scenes
Yep.
before you activate.
That's right.
The clients, it works the minute it shows up at home.
Yeah, yeah, yeah. Similar to like a regular mortgage, right? Being set up in the account. People tend to not receive their account information for 30, 60 days sometimes, but it's generally about 4 weeks. Just kidding.
Is there a set fee to start the process, or how do your fees work?
For getting the loan, for obtaining the loan, yeah. So our standard fees locally, and I'm probably not the appropriate person to talk to you about that.
So I think you answered it, it's the same as the traditional mortgage.
So you have a loan application fee.
So a 30, if you refinance it to a 30-year product, well, the other one is gonna look identical. If you buy with a 30 versus an old one, it's gonna look identical. So lender fees, appraisal fees, all of those fees.
In terms of the lender fee, for your lender fee, I know some lenders do a $900 fee, flat fee regardless, and then some are $1,800 plus all
Yes.
these miscellaneous.
Whatever that
things.
fee is, whatever that fee is for us, it'll be the same.
Ours locally is about 12.
Right.
How much?
1,200?
Yeah, 12, 20, something like that is what.
But you don't have interest collected or your escrow collected at purchase either, since they're not counted. You have savings at purchase, because you won't have those additional funds collected.
Yeah, so we like to escrow to 3 months or 6 months or whatever that is, that extra that they always take on refinance and purchase.
Okay, thank you.
Last 40 slides, so hang in. A couple resources for you guys. You might want to just either write this down or remember it. It's easy to remember. It goes by the brand name, allinOneLoan.com. If you go there, it hosts our calculator that's easy to use, and you can run through in a couple moments just to see how your own personal scenario or anybody else you know might benefit. It also has some other resources on there, FAQs, brochure, testimonials, things like that. We also perform live webinars each week, so if you want a refresher, a quick refresher, or you know somebody that might benefit from it, honestly, these are easy-going ways to just go in. They're non-threatening, it's not a sales job, it's just, they're performed by my colleague Erin Wood. It's a phenomenal job. She does these twice a week. Schedules are there. And no personal information is collected and used. It's essentially, yes, name and email address. We communicate with you, but we also need to know, like, how did you find out about this? Who are you associated with at CMG? So we can keep everybody in touch. But that's it. That's the presentation. And obviously, I'm going to hover here and answer any questions you guys might have for me. But I really appreciate the time you spent with me this morning.
Thank you.
Sure.
Just one comment. Antonio, we're friends, but you did a much better job than Gabe Wood's ever done.
All right. Man,
Hands down.
thank you. We'll work on that. Yes, sir.
Will you roll out any 0% down products?
What we do, what?
Will you roll out a 0% down product?
We won't. 10% is the minimum. Yeah, 10% is the minimum. And I don't see us going to the 100% range. Part of the product is cash flow and ability to save, right? So we would hope that people have a minimum of 10% down. But we also have other products that can be utilized with this to help build that 10% down payment.
So for instance, if someone doesn't pay 10%,
Yeah.
pays on the stock.
Yep.
So right now, the option is to go conventional 5% down.
Yep.
Is there a way to leverage?
Yep. So within 6 months, based on property value, if it's gone up, we can refinance potentially. right? But we still need equity, we still need that, you know, minimum 10% equity in the property or down payment to get into this property. Yeah. But we've got a product you can talk to us about called home funding. I don't know if you're familiar with that, that's, yeah.
Alright, hey, we still got a baseball to give away? You have to be present for it?
I got 5 minutes.
So, if you didn't win, it's Chet's fault, you back. So, Rebecca, Vicky.
Why, do I have to wait 4 weeks?
She did?
Oh, she left next.
She left, and then next is Jack Turbin.
Jack, you here? Next.
No? Chet. Chet. We need another name.
Other people leave?
Yep.
Oh, let me go draw.
Anybody else need to leave? I got 4 minutes to go.
And then, also, just real quick, all the links that Dave was.
Is Andrea Perez here? Thanks, everybody.
Andrea? Andrea, next.
Nope. So,
I like this
if
game.
you catch one of the loan officers, or I call them your sponsor, if they invited you, just make sure they have your email address and we can get all that stuff out to you as well.